CPA firm that focuses exclusively on independent contractors and self-employed, serving all 50 states. Please make sure to mute your microphones for a more enjoyable experience. That said, we really would like to hear from you and would like to involve you in the conversation. So ask questions and share comments by using the question and answer panel at the right side of your GoToWebinar player for the Q&A session at the end. We will do our best to respond to your questions. So at this point, I would like to introduce our featured speakers so we can get into the content. Brock Anderson is a CPA licensed in the state of Arizona and is a partner at IC Tax Advisors. Brock received a master's degree in accounting and taxation from the Marriott School of Business at Brigham Young University and spent much of his career consulting business owners at Deloitte & Touche. Today he's going to share some valuable information about how you can maximize your tax savings in 2015. Brock, welcome.
Thanks, Serena. All right, so it looks like we've got a pretty decent crowd here, and I know that there are people listening in from different parts of the country, and so I'm glad that you guys took the time to come in, and I really think that there's going to be some information today that can benefit you personally and also maybe be of benefit to your customers, your clients. Every bit of tax information that you know, especially if you work with real estate investors, there's a lot of really great information here as well. So with that said, let's just jump right into the content because we have quite a bit that we're going over today. So first of all, the question is often asked, why is it that we work exclusively with independent contractors? And really the reason is borne out in the statistics. There are something like between 12 to 20 million independent contractors in the U.S., most of whom are structured inefficiently, either as a sole proprietorship or as a corporation or an S corporation, but they're not using it properly. And so we're dedicated to both educating and helping those people structure themselves properly and operate their businesses in the most efficient way possible so that they can maximize the amount of money they have in their pockets at the end of the day. And so, going on with this line of thought, the whole reason this happens is because you're realtors, you're busy. We get it. I've bought a house and I've had realtors running frantically all over the place trying to find me the right place. And so I know that you're focused on making money. You're not necessarily focused on how to structure that properly or what's the best thing to do for tax purposes. And the reality is that small differences that you make can have a very significant impact on your taxes. So it's something that needs to have attention paid to it. It's not something that you should probably do on your own. You need help. But the problem historically has been that CPA firms charge very high rates. And so the costs of those things outweigh the benefits of the services. Seeing that, we've developed a model that we think is very effective at serving the independent contractor community and realtors in particular. And so we'll talk about some of those things today in addition to the specific strategies that we'd like to present to you. So let's see here. Diving right in, I'm going to talk a little bit about business structure. So I'm not exactly sure what everybody is structured as that's on the call today, but if we look at the statistics, there's a good chance that a lot of you are sole proprietors, and maybe some of you are S Corps, but the statistics say most of you are sole proprietors. So this will definitely be beneficial to those who are in that bucket. Here is a picture of a form that you're all very familiar with. You just filed this about a month ago, and it's your tax return. So this is the tax return example of a sole proprietor, and this could be a real estate, I should say a realtor. In this example, we're using somebody that earned $90,000. That isn't necessarily the case for all realtors. We understand that. It's just frankly, a number that we picked. And so I can teach you how you could arrive at the same results that I'm going to show you using your own numbers in just a moment. So right here we've just kind of highlighted to show you that as a sole proprietor, your income shows up on line 12 of a 1040, and here we show that in this example it's $90,000. Page 2 of that same tax return is going to show the taxes that result on that $90,000. You'll see that on line 57 there's about $12,000, actually just shy of $13,000 of the total tax bill that is self-employment taxes. So when you're a sole proprietor, everything that you earn is subject to both income taxes and self-employment taxes. And as you can see, self-employment taxes are oftentimes at least as painful as the income taxes. So it really becomes important to be able to shield those in any way possible. Now we're going to show an example here of the same person who structured their business as an S corporation. And we're going to use the exact same numbers just to bear out to you that the way that you structure your business is very important, because remember, this doesn't mean you have to go out and sell more, close more deals, find more clients. It's literally just structuring your business differently so that you have more money. So if we look at this, and I'm going to pull that up a little bit more clearly. So in this example, this person is splitting out their $90,000 between two categories, wages and business income. And actually you can see on line 17 where it says S corporations. So with an S corporation, you're able to treat yourself as both an owner and an employee of your own company. So that's important because now as an employee you can pay yourself a salary, which is what we're seeing on line 7, but you can also take dividends. And the dividends is where significant savings are generated. So anything that you take in the form of a dividend is not subject to self-employment taxes. So if we multiply, well, and that's what we're going to do here on the next slide. Shouldn't get ahead of myself. This same tax return shows the exact same taxes of that person earning $90,000 now using an S corporation. You'll see that the total amount of taxes has gone significantly down, as well as the self-employment taxes, almost cut in half. So here what we've done is we're comparing the two scenarios head to head. The total taxes in the S corporation example is $22,371, and the one that is just below it as a sole proprietor is paying almost $28,000 in taxes. That's a difference of almost $6,000, about $5,500, as you can see here, just because of the business structure. And this is pretty basic stuff. So there are definitely additional strategies that you can benefit from here using your S corporation. Now, let's go ahead and move into another item that frequently brings heartache to the independent contractors and tax advisors alike, something called the home office deduction. And the first question that I always hear, and you probably have too, is, oh, you know, the home office deduction, it's a red flag or it's a yellow flag. If I do that, I'm going to be targeted by the IRS for an audit. Well, I just don't understand that logic. I mean, there is a Form 8829 that the IRS produces here that is specifically for the use of deducting your home office. The problem that people get into, let's see here. So if you, whoops, got to go back. So then why does the home office deduction have such a bad rep? Well, it's a question of facts, circumstances, and documentation. Where most people get into trouble is that they simply don't have a home office and they're claiming it. Well, that's fraudulent, and yeah, you're going to get in trouble. So the key here is let's talk about what the requirements are and align your facts and circumstances in a way that it complies with the law so you can take it legitimately. In addition to that, there's been a lot of discussion recently about the new simplified method that the IRS issued back in 2013. There are some benefits to it. It is like it's called the simplified method. It's simple. One of the benefits, in addition to the simplicity, is that you don't have any recapture on the sale of that property. So if any of you who are familiar with, if you've depreciated a portion of your home, when you resell it, you have to recognize that amount that you depreciated as income. That's a bummer. So this safe harbor, if you will, allows you to avoid that. But this is at a cost, and there always is. When you take a safe harbor rule, it means you're giving something up. The IRS is saying you can do this, but you're probably not going to get as much of a tax deduction. So the next point to make that's very important is the home office deduction is very different depending on the structure of your business. So if you're a sole proprietor, you're going to use that form that we just showed you, the 8829, and it sticks out in your tax return. It's very obvious that you're taking a home office deduction. When you're an S corporation owner, which is what a lot of our clients use, they are able to deduct their home office without it appearing on any special form. It simply shows up as rent expense. And so there isn't even the ability to have it raised as a red or a yellow flag. So that's a really big benefit. And that's to that last point where an S corporation gets the benefits of the simplified method without the cost, meaning the higher taxes. So moving on to travel. Travel itself is, sometimes people get confused when they talk about travel and meals and entertainment and things, but travel itself is really airfare, mileage, subways. You know, it's getting from point A to point B, and then it's staying there overnight. So it's lodging as well. The general rule for whether or not travel is deductible is a question of intent. So is it primarily for business? And again, the tax law is up for interpretation. And so a really good rule of thumb is something that, you know, that you're going to spend the majority of your time engaged in business activities. Okay, well then what in the world does it mean to be spending a majority of your time in business activities? So I illustrated this with an example that I think helps more than any of the IRS literature could. So let's say that you're going to a trade show in San Diego from May 11th to May 14th. It's just coming up next week. That's a Monday through a Thursday. So you're leaving on the 10th, the day before. You spend 4.5 hours there. Well, on Monday through Thursday, you spend 4.5 hours at the convention. But you have a brother that lives there, and you go visit him each day as soon as you leave. So you spent 4.5 hours at the convention, and then you spent 10 hours with your brother. You head home on the 15th, and then so the question becomes, is the travel to and from San Diego, is the hotel, are all these things deductible? And the answer is absolutely yes. And that may not be intuitive, but the reason we can arrive at that is if you're spending 4.5 hours at a trade show, out of an 8-hour workday, that is by far a majority of your day. So the primary purpose is really measured by a standard business day. So it's just something to keep in mind. And you typically would not include weekend activities in that calculation. Now, of course, this doesn't cover, if you go there with your brother and then you guys visit Disneyland, you're going to want to leave that out of the business. Let's see here. Okay, so here's a question that we get a lot, and there's a lot of misconceptions around it, and hopefully I can clear some of this up. So if you're a realtor and you guys travel around a lot, you drive to different sites and things like that, should you buy or should you lease your vehicle? How do you make that decision? As usual, it depends. So a really important point that I have to make up front is if you use your vehicle for personal use at all, some portion of the vehicle will be limited in what you can deduct. That's just the way it is. Unless it's purely business, then some amount of that will not be deductible. That's related to the personal use. Also, before we get into a discussion about should I rent or should I purchase or should I lease, there are some non-tax considerations that I always like to bring up with clients. I mean, if you're letting tax be the only factor in this decision, you're missing some really important points. So when you lease a vehicle, there are usually mileage caps. You can't drive more than 12, sometimes up to 16,000 miles per year. Well, if you're driving a lot more than that, then a lease probably isn't a very good idea, because you're going to get clobbered at the end of that lease with extra fees relating to the extra miles that you drove. So it's something to consider that has nothing to do with taxes. Also, just the maintenance in terms of if you were buying a vehicle and it was older versus a lease, which is, sometimes has that included. And then also a really important question is, how often do you want to have a new car? If you're if you're the type that every 2 years you want to have a new set of wheels, there's a really strong economic argument for leasing, because you don't suffer as much of the depreciation losses. But if you're the type that buys and holds it and drives it into the ground, then you'd have to do the mathematics, but a lot of times that bears out to be better for purchases. To really help summarize this, I've put together what I call the leasing versus buying a vehicle decision matrix. And the way that this works, you'll see that along the top you've got buy and lease, and then on the left-hand side you have the two ways or the two methods you can use to expense or deduct that vehicle. So with any vehicle, you can use what's called either the mileage deduction, the standard mileage deduction. You're probably familiar with that. In 2015, that's 57.5 cents. You're also, as an alternative, you can use what's called, the depreciation method or the actual expenses method. And in that case, you're not using the mileage rate. So it's one or the other. And so in order to determine which one of these four quadrants is going to be best for you, should I buy and should I use the mileage, or should I use buy and depreciate? Basically, take the car that you're considering buying and put it into each one of these quadrants, multiply that out, and see where the benefit lands. So if you're going to buy a vehicle and drive it 100,000 miles each year, you're going to have a very high business mileage deduction, versus the depreciate option below, where you're probably going to be limited to a maximum of $3,160. And so the lease is very similar to that. The big difference with leases, and this is sometimes why you'll see very expensive cars fall under what's called the lease exclusion, or like if you're in LA or here in Scottsdale, whenever you see a really nice car, oftentimes it's leased. And the reason for that is if a business owner knows that there's a limit of $33,160 that they can deduct per year if they buy it, they can get around that limitation by leasing it. They do have to add back a small amount called the lease inclusion, but it's so small that it's barely worth even mentioning here. So this is a great slide, and we'll be sending this out afterwards. So if it's something you want to use because that's the kind of a decision you're trying to make, then take a look at that. We frequently talk about using family members as a way to reduce your taxes, and people, that's always interesting. How does that work? Well, let me first kind of give you the scenario where this kind of thing works. If I've got kids, I've got, let's say, an 8-year-old and a 10-year-old. Well, the way that I look at them, I've got two little tax brackets running around my house that are costing me a fortune, but I'm not taking advantage of their tax brackets. Well, when you're an independent contractor, when you're a realtor, you can actually very much take advantage of their tax brackets. And this slide shows us how that works. So you'll see on the left-hand side that we've got the 2015 tax rates along with the brackets for a married filing jointly coupled. Well, you could do the same analysis with a single person. We just happen to choose that one. On the right-hand side, you would see the single filer tax brackets, and this is what would apply to, you know, Junior that's 8 years old and you know, my 8 and 10-year-old. So what we can do is, and by the way, this strategy is particularly helpful for higher income people. So if you're a real high producer in real estate, then this is definitely something that can become of benefit. It's not something that I typically start to recommend until maybe the 28% tax bracket, sometimes the higher ends of the 25% tax bracket. But basically what we do is we can actually pay your children from your business to do legitimate jobs, you know, go get the mail, sort the mail between personal and business, clean out the home office, you know, maybe they help sort whenever you've got a receipt for something, you give it to them and they're the ones that file that away. Anyway, there's a lot of different jobs that you can give them and pay them. Now the idea is you don't want to pay them over a certain amount. And a lot of times what people do is they'll pay their kids up to about, what is it this year? I want to say $6,000. Basically the personal exemption amount, because it's completely tax-free. So you can move money from your tax bracket, let's say you're in a 25% tax bracket, into a 0% tax bracket. And if that's $6,000 that you shifted over at 25%, that's a $1,500 tax savings. And the key here is you don't have to give control of that money to your children. They don't even have to know that they own it. And that can be used for anything. Well, not anything, most things. It could be used for family vacations. It can certainly be used for their education expenses. The IRS does not like to see you use it for their clothing or for their food, because they consider that to be items that you should have to provide for them as your parent, as a parent. But frankly, in a lot of ways, this is a better option than using a Coverdale or you know, one of these college savings plans, because those restrict how you can use those funds. In this case, they're getting tax-free money, and that can be used for their education. It can be used for anything, for a down payment on their first home. It could be put into a Roth IRA and grow tax-free. For, you know, they could be, you know, years ahead of their peers by the time they're 30 years old, just because of these contributions to Roth IRAs. So it's something to consider. We're going to talk briefly about the real estate professional tax status, and I don't know that this is something that even applies to anyone listening today, but certainly you run into potential clients or clients that ask you about this and wonder, hey, is this something I should do? And maybe you own a real estate portfolio and you've run into issues where you've wondered if this is a good fit for you. So first, let's talk about what it is. The real estate professional tax status is where you can treat real estate activity, so rental real estate activity, as an active source of income. This is important because, and I think we're going to go over it probably in the next slide, because of something called passive activity losses. So when you have passive activity losses, meaning income that comes from a passive source, you can't take those passive activity losses only to the extent that you have passive income, with a couple of exceptions, and we'll go over that. But without getting too much in the weeds on this, if you do satisfy the requirements, meaning you put in 750 plus hours in personal services for real estate, meaning you're cleaning out you're plunging the toilets, you're mowing the lawns, you're taking care of the properties, or even if that means you're managing them, you're calling other people to take care of those things. So you need to have at least 750 hours for that, and those 750 hours have to represent more than half of all other services that you provide. So if you have another gig, another job, and you're working 900 or 1,000 hours in that job, you wouldn't satisfy the requirements for this, because the 750 in the real estate has to be more. And the other thing with a recent court ruling, or not a court ruling rather, but an IRS ruling, is that the real estate professional status does not prevent the 3.8 net investment tax. So if that's something you were hoping to use to avoid that, that has been cleared up. It's not going to work. There's some additional tests that you have to apply to. And this is an area where if it's really something that you can benefit from because you have a pretty substantial real estate portfolio, you're going to want to talk and have a one-on-one conversation. I'd be happy to do that. But it's not always the greatest option. It's not always a save-all. And there are other ways to take advantage of passive activity losses, which is what we're going to talk about right now. So P.A.L.s. CPAs, we're not creative people. So passive activity losses, otherwise known as P.A.L.s, stands for when you have passive losses that are in excess of passive activity income. And this is a really common problem, maybe for you. Maybe you own real estate, maybe you have clients that own real estate and it's a big concern, and they say, you know what, I don't want to buy any more real estate because I'm not even getting the benefit of the losses that I'm generating on my current real estate holdings. Well, in some cases we can get around that. So I want to present a couple of strategies for doing that. All right, the first one that most people know about is the $25,000 allowance. So if you make under $100,000, it's based on, you know, modified adjusted gross income, then it starts to get phased out. But if you make less than that, then up to $25,000 of your passive activity losses can be deducted against other sources of income. If that's no good for you, then one thing you can do is if you own a property that's perpetually generating a passive activity loss, you can sell that property to unlock those passive activity losses and take advantage of it in that year. So this gives you the control to be able to say, hey, you know what, this year I really need help bringing my income down, so I can sell that property with all those passive activity losses and have a significant impact on my tax return. That's something you need to work closely with your CPA. And this is a strategy that I really like. It doesn't work for every taxpayer, but if you have passive activity losses that you can't take advantage of because you make too much money, and either you or your spouse own a business. So this works really well a lot of times for realtors. So realtors who have a portfolio of real estate, what you can do is, if your spouse isn't an owner in your business or they're not active in it, you can give them an ownership interest, but that of course we would want to treat as a passive income interest. So what would happen effectively is that income that normally to you, because you're the owner of this business, that's treated as active income. We can pass that on to your spouse, to whom that is going to be treated as passive income. And so with passive income, you can use that to offset passive losses. And this can get really confusing, and but it's a great strategy and can be very effective. So if that's a situation that applies to you, certainly reach out to us and let's talk. Okay, so now back a little bit to what I was alluding to in the beginning of the webinar, and that is that, you know, we work solely with you, with people just like you. And our services are designed specifically not only for your needs, but also to help you reduce your taxes. We want the taxes that we help you generate to more than offset the costs of our services. That's really our goal. And so I believe the next couple of slides are going to go ahead and describe how that works a little bit. But before I do that, I just want to point out that I've put in quite a few plugs for the idea of an S corporation, and I should mention that an S corporation is not for everybody. So there is more effort involved with an S corporation, and the compliance is a little bit more involved. The savings can be significant, like we pointed out earlier, but the threshold that we use here at the firm, as a measuring stick is if your business is making $30,000 or more a year, it definitely makes sense to do an S Corp and make that election. Once you do that, there are going to be some extra requirements on you that you haven't had previously. And so we help you take care of all that. That's exactly why we exist, to make sure that you can implement the S Corp strategy effectively and reap those benefits. So I can see we're probably going to run out of time here. So I'm going to go through this pretty quickly. But as a client of IC Tax Advisors, first off, you're assigned a CPA. And we want to make sure that that CPA is the main contact on your account, oversees the implementation of your strategy, helps you know what your role is in that. Additionally, you are assigned a bookkeeper. And that bookkeeper works closely with you to categorize your transactions and keep a running set of financials that we issue to you regularly. And that's one of the requirements of having an S corporation. So I'm just going to skip that. With the whole idea of this being that we end up generating significant tax savings for you. And we have clients all over the country that do this and benefit from it in a big way. So here's just a slide that kind of indicates a higher level of what those taxes entail. So we really are trying to bill ourselves as your full back office. We want to take care of your taxes. Being a 1099 contractor can be complicated. It can be very simple if you're a sole proprietor and you're okay with paying extra taxes. But if you want to be an S Corp and you want to benefit from those things, you really want to engage a professional. So with that said, that's the presentation that I prepared for today. And so I'm going to go ahead and pass the baton back to Dorina for the Q&A session. I'm still going to be around here, but I think she's going to run the show at this point.
Brock, thank you so much for the presentation. So realtors, now you're able to ask your questions by typing them in the messaging box on the right side on your GoToWebinar panel. While you're typing, Brock is going to answer some of the questions that were sent to us ahead of time. So this first question comes from Sam. And Sam is asking, would it be beneficial to open up an S Corp in the middle of the year, or should I wait until January?
So this is a common question. People want to know, you know, Brock, it's too late, right? I need to wait until January, and that's just not the case at all. So I would encourage anybody that can benefit from an S Corp type of setup to, at a minimum, form your LLC as soon as possible. That's the first step, is having the LLC. And from there, we have a little bit of wiggle room in terms of when we make the S election. But it's not uncommon for clients to set up in the middle of the year and still be able to save thousands of dollars by the end of the year. But the key here is the sooner you get it set up for any given year, the sooner you do start generating those tax savings. And, you know, if that's something that you wanted to explore with us, I just encourage you to reach out to us.
Wonderful. Thank you so much. This other question is also from Sam. The question is, can I deduct my 401k? If so, how much am I allowed to spare per year?
So, yes. I mean, assuming you are an independent contractor and you have this business, then you can actually do some really cool stuff. One thing that our clients do pretty frequently and this works if you have an S corporation, is you set up what's called a solo 401k, and the contribution limits on a solo 401k in 2015 is actually $53,000. I mean, it's huge, especially when you compare that to what you can do with a regular 401k of $18,000 if you were an employee somewhere. So it's definitely something worth looking into. Great question. Great question.
Great, thank you, Brock. There's some questions coming through right now. This one is from Mark. My accountant told me that I shouldn't do an S Corp until I hit $200,000 per year. Is it true?
So the reason your accountant is telling you that you should wait until you hit $200,000 a year is because probably the fees that they're going to charge you in order to implement this is going to be so high that you need to be making $200,000 in order for the tax savings to justify the costs. And that's been the problem historically, because this strategy isn't new. It's just that it's been out of reach for most people because it's just been too expensive to implement. The threshold we use is $30,000. And we still work with clients that make less than that, and we use other strategies. It's just that this is such a big one. But yeah, $30,000 is the threshold. If you're there, you definitely need to be doing this. If not, it's still not a bad idea to set up your LLC in preparation for when you do cross over that threshold. So I would have to disagree with the accountant that told you you needed to make $200,000 a year.
Great, thank you so much. It seems like S Corp to be a very popular theme today. So another question is from Steve, and the question is, how difficult is it going to transition an LLC to S Corp, and will I still have my LLC if I do that?
It's not difficult at all. We'd want to see if you come into our firm with an LLC that you formed on your own, we need to take a look at it. But we can prepare that S-election for you. That's something that we do for most of our clients at no cost. And you know, so it's basically a filing with the IRS, and you just have to know how to do it. Particularly if, you know, like in this time of the year, we oftentimes have to do what's called a retroactive S-election. And that's not a problem, but you need to know how to do it, and that's not common knowledge out there. So.
Thank you. Kim is asking S Corp versus P.A.L.s.
Okay, so S Corp versus P.A.L.s. Great question. So a P.A.L.s. is really just an LLC, but it's only for professionals. So doctors, architects, dentists, CPAs, and so there's not a huge difference other than that designation. Only those certain professions can have a P.A.L.s. And in fact, some jurisdictions require professionals to have a P.A.L.s. instead of an LLC. Now, that's the legal side of it. We can convert a P.A.L.s. into an S Corp. So it's really the question of S Corp versus P.A.L.s. is really more of a question of, can a P.A.L.s. be an S Corp? And that answer is yes. So, because you have to remember, and I maybe didn't point this out very well earlier, but the LLC or the P.A.L.s. itself, that's just the legal entity. That's the legal structure. The S corporation is a tax structure. So when we convert it into an S corporation, we're not actually changing the legal structure. It is still a P.A.L.s. But yeah, that's a great question.
Wonderful, thank you. Elizabeth is asking, will the home deduction raise a red flag from the IRS?
So this must have been a question that came in before the presentation, because I think we kind of addressed that. But it will if you're not using it properly. If you're using it legitimately, no. It's all about documentation and just taking it properly, and that's a discussion you need to have with your advisor to make sure that you align with what the law requires. And if you do, just like anything else, you don't have to worry about it.
Great, thank you. Next question is coming from Sue. If I buy a vehicle, should I buy it in the name of my business or my personal name?
I get this quite a bit, actually. So this isn't so much a tax question, believe it or not, because the way that we're going to deduct the vehicle will depend more on who is paying for the vehicle than who the vehicle is titled to. Because I see all kinds of situations where a car is titled to the business, but it's really being paid for by the individual, and vice versa. So I generally recommend against buying a vehicle in the name of the LLC, unless, and this is the only circumstance where I think that that's okay. If that vehicle is used solely for business, you don't use it for personal at all, then yeah, you can go ahead and run that through the business. But one of the reasons you don't want to have it titled to your business is because oftentimes auto insurance is going to be more expensive if it's titled to a business, simply because it's titled to a business. That's considered to be a higher lawsuit risk, and you're also putting your business at risk when you do that. So I don't think that's of course, I've heard the flip side to that. Some people say, well, hey, if I put it in the name of my business and I get one of those radar tickets at the intersections, they can't tie it to me because it's titled to my business. And that's an entirely different question, but I generally recommend having it titled in your own name unless it's used purely for business.
Great, thank you, Brock. Another question from Kim. What are the fees to set up an S Corp?
So it's really a question of how much, what are the fees to set up, but because an S corporation does not exist as an entity. It's not a legal entity. It's a tax status, and so the cost to form an LLC or a regular corporation is what you want to ask, and either one of those entities can be converted into an S corporation, and that's a state-to-state issue. We actually form entities for our clients all the time, and our fees are right in line with like a LegalZoom. I think we charge the exact same, maybe even a little bit less. The advantage of doing it through us is that you have the benefit of your CPA reviewing the documents, as well as having having an attorney take a look at it. But just to give you a reference point, our fee is $230, and then plus whatever your state filing fee is. So, you know, here in Arizona it's very cheap. It's about $85 is the state filing fee. Illinois is pretty expensive at, I want to say, I just did one today, $650 is what the state charges, and there's everything in between. So, and then California has some of its own unique issues as well.
Great, thank you so much. I have a question from Elizabeth. She asked, how much hassle is it to switch from my current CPA to you guys?
I like those kinds of questions. So it's not difficult at all. We try to make this as painless as possible. We work in an industry with independent contractors where your situations are constantly in flux. I mean, feast or famine. Sometimes you're independent contractors and then you switch to W-2 and back and forth. And that's just kind of the world that we live in. And so we're very used to helping our clients transition. So every situation is a little bit different, and it would definitely require a discussion about what you have going on right now. But we transition clients over to our firm literally every single day. And you know, we have clients in nearly every single state in the country. So in terms of effort, it's really not much. It's really not much. And our expectation is that in working with us, we will save you money. We're really interested in this being an investment where we're providing you a service that will more than offset the cost of those services.
Wonderful. Thank you so much, Brock. It looks like that's all of the time we have for our webinar today. You guys, please feel free to reach out to us for a free consultation. The phone number and emails are on the screen. Also, please keep an eye for an email with a recording of the webinar. Also, if you will, take a moment to fill out our one-question exit survey. On behalf of Brock Anderson, as well as the team of IC Tax Advisors, thank you for joining us today and taking time to view our presentation. My name is Dorina Koltsova, and you guys have a wonderful day.